Yeah, so good evening to you all. Claire, Charlotte, Lynn, I see you all joined. So today we are looking at partnerships. That's our topic for today. I don't know whether I'm very, very clear to you all. Members, am I clear?
Yes, you are to me.
All right, so we are looking at partnership accounts. We are looking at partnership accounts. Now, when you try to look at what we have covered so far in the past lectures, we have looked at how to come up with the books of accounts, how to come up with the financial statements for sole traders. Remember, a sole trader, we said that a sole trader, that is a business, sole proprietorship, that is a form of a business which is owned, controlled, and managed by one individual. Okay? But of course, trading as a sole trader has different advantages as well as disadvantages. One of the advantages of trading as a sole trader, first of all, you have complete control over how the business is run. Then the business is established with minimum what? With the minimum capital. But of course, as we know, there are several disadvantages when it comes to sole what? When it comes to sole traders. First of all, sole traders have unlimited liability for the debts of the business. Sole traders, of course, may involve long hours of work, so you overwork yourself if you're working as a sole trader. Then sometimes you find that it may be difficult for sole traders to raise extra finance when that finance is needed. It may be kind of difficult for you to raise extra finance. Now, today we are going to look at partnership accounts. It's what we are going to look at today. We are going to see what is a partnership. What could be some of the advantages and disadvantages of trading as a partnership business? And then still, how do we deal with the accounting for partnerships? How do we do partnership accounting? Now, if I'm to ask, what is a partnership? Who can tell us what's a partnership? Clear, what's a partnership business?
I may say it's a joint business.
It's a joint business.
Yeah.
What happens in such a business?
Normally, I think you pull different people may pull resources together to come up with a business.
So different partners come together. They start up a business with the aim of making profits, because their main aim is to make profits. Okay, their main aim is to make what? Their main aim is to make profits. So that's a partnership. Their main aim is to make profits. Now, what do you think are the advantages and disadvantages of trading as a partnership business? What could be the advantages and disadvantages of trading as a partnership business? Lynn, advantages and disadvantages of trading as a partnership business.
I think there is sharing of losses.
Sorry?
Sharing of profits and losses.
Profits and losses are shared. Okay, that can be an advantage. Then what else? Which other advantages?
Capital can easily be raised by different partners.
But capital can easily be raised, so there is access to more capital. Then partners can share the workload, partners can pull ideas and share problems. Those can all be advantages. Then what about the disadvantages? What could be the disadvantages now?
It involves bureaucracy.
Bureaucracy. Then what else?
If at all one partner makes a makes okay, if at all one partner makes I don't know how to phrase it. If at all one partner presents others.
If at all one partner does what?
Okay, one partner's doing affects others.
Okay. Okay, in case a partner may be, okay, what we can say is that partners have less independence. Okay. You're not independent as a partner. Partners have less what? Partners have less independence than the sole traders. Decisions have to be agreed upon by all the partners. Okay. Decisions have to be agreed upon by all the partners. Then you also find that partners, when it comes to partnership business, the number of partners are limited to 20. Okay, the number of partners are limited to 20. So what happens if more partners are interested in joining? So there may be a limitation when it comes to the number of partners you're admitting into the partnership. Then the other thing is that partners have unlimited liability for the debts of the business. That can also be a disadvantage. Now, what are the characteristics of a partnership business? When it comes to the characteristics of a partnership business, first of all, the partnership is always formed to make profits. That is one thing which you need to know, that the partnership is formed to make profits. That's the main goal. Then the partners must obey the law as given in the Partnership Act. There is the Partnership Act, which guides on how to run a partnership business. Normally, there can be a minimum of 2 partners and a maximum of what? And a maximum of 20, and a maximum of 20 partners. Then each partner must pay their share of any debt that the partnership could not pay. And if necessary, they could be forced to sell all their private possessions to pay their share of the debts. This can be said to be unlimited liability. So where the partners have unlimited liability, then it can be a disadvantage, of course. But where they have a limited liability, then that can be an advantage in the case they fail to pay the debts of the business. Then partners who are not limited partners are known as general what? They are known as general partners. They are known as general partners. So there is what we call limited partnership as well as unlimited partnership. So where it's not a limited partnership, then we refer to that as a general partnership business. So there is limited partnership in the notes, something which you can read about. From there, we can also look at partnership agreement. Now, if we start a partnership business, we have to come up with an agreement. We have to come up with an agreement. Why do we need the agreement? Of course, if we have an agreement, it's going to reduce the possibility of any disputes arising. Okay? So there always has to be a partnership agreement. Now, in this partnership agreement, of course, we have different contents in the partnership agreements. One of the contents in the partnership agreement, we have to look at the capital to be contributed by each partner. If we are partners, we have Lynn, Huntington, there is Claire, there is Kovia, there is Mary, there is Jane. We have to agree on how much each of us should contribute, Then remember, we are going to share the profits and losses. We have to agree on how these profits or losses are going to be shared. We have to agree on that. Then the rate of interest, if any, to be paid on capital before the profits are shared, we also have to agree on that rate of interest. The rate of interest on drawings, that is, if we accept drawings, then salaries to be paid to the partners, arrangements for the admission of the new partner. Sometimes there may be need for admitting a new partner. So this should be clear in our partnership agreement. What are the procedures of admitting a new partner in case? Then if someone is retiring or in case of death of a partner, what are the procedures? So those are some of the contents of a partnership agreement. Okay? Those are some of the contents of the partnership agreement. So all this should be very clear in the partnership agreement. I've told you there will always be need for this agreement to reduce the possibility of any disputes that may arise. Okay? Now, capital contribution. Let us try to look at some of these items one by one. Capital contributions. We have to agree on how much each partner should contribute. Of course, it's not a must that partners should contribute equal amounts of capital. No. Their financial strength may not be the same. So we have to know how much we should contribute each. Okay? Then profit or loss sharing ratios. Remember, profits are going to be made at the end of the period because we are in business. So any profit or loss will be made. And then how are we going to share those profits or losses? The interest on capital. Remember, when you introduce capital into the business, you should get a return on your capital. Okay? You should get a return on your capital. So if I contribute more capital, of course, I'm going to get a higher return. My interest on capital is going to be high. Okay? If you introduce less capital, still what you earn as interest is going to be what? It's going to be less simply because you have contributed less. So this interest on capital is always charged to motivate the partners for them to introduce more capital into the business. Then from interest on capital, there is also interest on drawings. Now you may ask yourself, why do they charge interest on drawings? When it comes to drawings, this is where partners are taking out money from the business. Charlotte comes, withdraws money from the business. Claire also comes, withdraws. Scovia comes, withdraws. Now, if we are all withdrawing money from the business, there will be that time when we need money, but when it's not there, we need cash, but it's not there. Why? Because we have been all withdrawing. So what they normally do, they introduce what we call interest on drawings. Now, why do the partners charge interest on drawings? This interest on drawings is charged to discourage partners from withdrawing excessive amounts from the business. Yes, they will charge interest to discourage you from withdrawing excessive amounts from the business, because the business needs cash at the end of the day. So if we all keep on withdrawing, then there will be that time when we don't have cash, but we need it. So to discourage you from withdrawing excessive cash, they will charge interest on the drawings. Partnership salaries. One partner may have more responsibility or task than the others. Maybe one is too experienced. They have extra skills which others don't have. We may decide to reward them with a salary. Okay? we may decide to reward them with what? With a salary. So we have to agree on this. Who is getting a salary and why is this person getting a salary? Okay, we have to agree on that. Performance-related payments to partners. In the case of commissions or some other bonuses, all these should be clear in the partnership agreement. We have to agree on all this. So those are some of the contents of the partnership agreement. Those are some of the contents of the partnership agreement. Now, from there, we need to look at the financial statements. Are the financial statements of the partnership different from those of the sole traders, or they are the same? We need to find out. How do they come up with their financial statements? Now, one thing you need to know about a partnership business and its financial statements, its financial statements are similar to those of a sole trader. A sole trader prepares an income statement. A partnership, they also prepare an income statement. A sole trader prepares a balance sheet. The partnership also prepares a balance sheet. However, when it comes to the income statement of a partnership, there is that extra section which we have to add, and this is shown under the profit and loss account. This section is called the profit and loss appropriation account. We call it the profit and loss appropriation account. It is in this account that the distribution of profits is shown. Remember, profits have to be distributed among the partners. So we prepare that profit and loss appropriation account to show how these profits are going to be distributed. Okay, so that is known as the appropriation account. How do we come up with the appropriation account? This is the format of the appropriation account. Those with the notes already, this is already in the notes you have. So this is the format of the appropriation account. Normally what we do, we have to get our profit. We have to come up with our profit, that is the net profit. This net profit is from the income statement. So we get that income, we get that net profit from the income statement, and then after getting that net profit, there are some appropriations that have to be made on these profits. So we make what we call an appropriation of profits. We make an appropriation of profits, and these are some of the points, or these are some of the items which you deal with when it comes to appropriation of profits. After getting your net profit, then you have to add the interest on the drawings. We have to add the interest on the drawings. We have to add the interest on the drawings. So assuming we have two partners, Taylor and Clark, we get their interest on the drawings, then we add it to our net what? We add it to our net profit. Okay. Then after showing the interest on drawings, after adding it, then we have to less the salary. Assuming there is a partner who receives a salary, that salary is going to be deducted. So assuming Clark receives a salary, we are going to deduct that salary. So a salary, partner salary is an appropriation to profits. Then you also have to less the interest on capital. We have to less the interest on what? We have to less the interest on capital. So we calculate the interest on capital for both partners, then we less that. Then finally, what you come up with is the profits to be what? Is the profits to be shared. So after getting the profits to be shared, then these profits have to be shared by the partners according to their profit and loss sharing what? According to their profit and loss sharing ratios. according to their profit and loss sharing ratios. As you can see, that now you have to get what we call the profit share. That is Taylor, the profit ratio times the profits to be what? Times the profits to be shared. Times the profit to be, times the profit to be shared. Then Clark, profit ratio times the profit to be shared, assuming that our partners, we have Taylor and Clark. So that is the appropriation account. So whenever you're dealing with partnership numbers and you're required to prepare an income statement, just know you also have to come up with what we call an appropriation account in addition to the income statement. So this comes as an extra section of the income statement. After getting your net profit, then you add what we call the appropriation account. Okay? From the appropriation account, there is something which we need to look at. Now, in partnership, the partners will prepare what we call a current account as well as a capital account. Each partner has a current account as well as a capital account. But before we look at the capital account and the current account, we have what we call fixed and fluctuating capital accounts. Fixed and fluctuating capital accounts. Now, in the exams, the examiner will always state which method you're going to use. Are you going to use the fixed capital account or you're going to use the fluctuating capital account? So there are two choices that are always open to the partnerships. There is a fixed capital account plus current accounts, and then there can also be what we call the fluctuating capital account. Okay. Now, if we use the fixed capital account, then we also have to prepare what we call a current account. So here, two separate accounts will be prepared. The capital account, which is fixed, and what? And then the current account. The capital account for each partner remains year by year at the figure of the capital put into the firm by the partners. So the fixed capital account shows the same capital account balance year after year, unless maybe the partners have introduced some extra capital. But if that is not the case, then the capital will be the same year after year. So that is how a capital account looks like. Remember, an account has a debit side as well as a credit side. So assuming this is the partner's capital account, you have Taylor and Clark. The balance brought down is shown on the credit, and in case of any additional capital, still that capital will be credited. Then you come up with a balance carried down on the opposite side. So that balance is going to be maintained year after year. It's like someone has a question, right?
Yeah.
Okay. Sorry? Someone has a question? No question? Okay, let us yes, please. Yes, you can ask your question in case you have one. You're not clear. Not clear. Maybe you can use the chat box. You can use the chat, then I'll read your question in case. So the profits, interest on capital, and the salaries to which the partner may be entitled are then credited to a separate current account for the partner. And the drawings and the interest on drawings are debited to each. And the interest on drawings, the drawings are debited to that current account. Of course, the balance of the current account at the end of each financial year will then represent the amount of the undrawn, or what we call the withdrawn profits. A credit balance will be undrawn profits, while a debit balance will be drawings in excess of the profits which the partner was entitled. So that will be the partner's current account in the case. Now we need to know what is the difference between a partner's current account and a partner's capital account. These two are not the same. These two are not the same. What do you think is the difference between the capital account and the current account? What could be the difference between the two, current account and capital account? Peter, what is the difference between the capital account and the current account? Anyone with an idea the difference between the capital account and the current account?
Anyway, the capital account, yeah, our partners only involves the amount of capital a partner contributed at the start and any additional capital contributed in the course of operating their business. But when you look at the current account involves the interest. It involves a number of things like the interest on capital, drawings, interest on drawings, and any partner, any salary of a partner, if any. Yeah, that's what I can give you, Mrs. For now.
Okay, okay. Now what we can note that down somewhere, maybe in the notes. We can just put something small about these two accounts, because you need to know the difference between the current account as well as the partner's capital account. We don't know the difference between the two. Now, the partner's capital account you can note this somewhere, the partner's capital account. Now, this one shows the deliberate injections. Show the deliberate injections of capital, okay? The deliberate injections of capital into the business. It shows the deliberate injections of capital into the what? Into the business. Into the business. That is the partner's capital account. So for it strictly deals with capital, okay? The capital contributions of the partners, what the partners have contributed, what they have injected into the business, we record that in the partner's capital account. So it records the amount that have been invested by the partners into the business. Then the partner's current account. The partner's current account. Now, when it comes to the current account, now this records entries. It records entries relating to each partner's share of profits. It records entries to each partner's share of profits of the business. Profits of the business. That is the current account. So for it, we are looking at that amount you're earning through the trading activities, okay? Yes, that is the partner's current account, okay? That's the partner's current account. So it records entries related to each partner's share of profits of the business. Then it also records appropriations as well. It records appropriation of profits. It records appropriation of what? Profits. I.e. things like partners' salary, the things we have looked at. Partners' salary, things like drawings. Sorry, interest on drawings. Okay. Interest on drawings. The drawings still, we enter them in the drawings. Interest on capital drawings, etc. So it records those appropriation to profits. Now you see the difference. The partner's capital account is strictly for capital. Then the partner's current account relating to each partner's share of the profits of the business. Records appropriation of profits, i.e. the partner's salary, drawings, interest on capital, and interest on drawings as well. So you can note that down maybe to make it more clear. So we normally separate the capital account from the current account. Capital account, we use it strictly for the amounts invested by the partners into the business. Then their shares from the trading activities of the business, we record them in the partner's current account. So that is it for the current and capital accounts. Now, what happens if no agreement exists? What happens if no agreement exists? Remember, we talked about the partnership agreement, and we said that there has to be a partnership agreement to avoid any possibility of disputes that may arise in the future. So where there is no partnership agreement, then of course we expect to see the following. Profits and losses are to be shared equally. There is to be no interest allowed on capital, no interest to be charged on drawings, salaries are not allowed. Partners who put a sum of money into the partnership in excess of the capital, they have agreed to subscribe, they are entitled to interest at the rate of 5% per annum on such advance. So you need to know what happens if a partnership agreement does not exist. Those points are there. You need to look at them as well. Then the balance sheet. The balance sheet. The balance sheet of the partnership, of course, it's the same like that of the sole trader. The same balance sheet. Okay. However, when it comes to the balance sheet, we have a capital account as well as a current account. We have to show these accounts separately in the balance sheet. We have to show these accounts separately in the balance what? In the balance sheet. So you show the capital accounts, you show the partners with their capital account balances, then you also show the current accounts. You show the partners with their current account balances. Now they're telling us that if one of the current accounts had finished in debit, if one of the current accounts had finished in debit, then the figure would appear in brackets. Okay? The figure would appear in what? The figure would appear in brackets. So that is a partnership. Now we are going to look at a question. We see how we can come up with the appropriation account, how we can come up with the capital accounts as well as the current accounts, and then how we can come up with a balance sheet for the partners. Okay, so we are going to see how to do that. So I have some sample questions here which I'm going to use for the purposes of this lecture. This is what we have. That's what we have. So I don't know who is going to read for us. Peter, are you in position to read for us? Lynn is also there. Charlotte is there. Claire, Jane. We have that information there. So who is going to read for us? We need to work out this and we see how we can come up with the appropriation account, how we can do the income statement, and so on. Claire, can you read for us? Is the screen clear?
Yes, it is.
All right, so there we are.
Do I start?
Yes, you can start. So,
Frame and French are in partnership, sharing profits and losses in the ratios of 3/5, then 2/5, respectively. The following is their trial balance as at 30th September 2015. Now these are the costings. Buildings costing £210. Then we have fixtures at a cost of 8,200. Then we have provision for depreciation, that is fixtures, which is at credit. Do I have to read out the debit and credit side?
okay, just take us through what is given, not everything. Just look at the items given,
I'm going
then
to
the
read
additional information. All right, it's okay.
Then we have the debtors, we have the cash, the creditors, then the cash at bank, stock at 30th September 2014. Then we have sales, we have purchases, we have carriage outwards, discounts allowed, loan interests, P-prints, office expenses, salaries and wages, bad debts, profit for doubtful debts, loan from P-prints, then capital for Frame and French, then current accounts for Frame and French as well. Then we have the indication of drawings for Frame. Can we continue? Are we stopping there? That's what I can see. Then we look at required. Prepare a trading and profit and loss appropriation account for the year ended 30th June 2019 and a balance sheet as at that date. A is stock as at 30th June 2019 at £74,210. Then expenses to be accrued. Office expenses at which at £215, then wages at £720. Next is depreciate fixtures 15% on reducing balance basis. Buildings at £5,000, then reduce provision for doubtful debts to £250. Then partnership salary, which is at £30,000 to Frame and not yet entered. Interest on drawings, Frame at £900. while French at £600. Then the interest on capital account balances at 5%. That is required.
Yeah, so that's the question. That's our question. You're going to come up with the trading profit and loss account, the trading and profit and loss appropriation account for the year ended 30th June 2009, and the balance sheet. But of course, you have some additional information in there. So this is still going to help us to see how we can master how to come up with a statement of profit and loss, and then how to come up with a statement of financial position. So if you're still stuck on how to do the balance sheet, how to come up with the income statement, this is going to still help you to master how to come up with those two statements, as we are going to see. Okay, so we are going to come up with our income statement, and then the appropriation account, as well as the balance sheet for the partnership. I don't know where the screen is. I've shared this question in the WhatsApp group. I don't know, because I don't be able to keep on going back to the question. You need to use that paper I've shared, the question paper I've shared in the group, to read the different values as we may need them here. Now, the first thing you have to do, you have to write the heading. We have two partners, that is frame and who. We have frame and the French. Those are the two partners which we have, frame and French. So we have frame and the French. Those are the two partners which we have. We are required to prepare a trading and profit and loss account for the year ended 30th September 2005. So I can simply say statement of profit or loss, because that's what they will ask you to come up with. Statement of profit or loss.
Senior, your screen is not showing.
The screen is not. Okay, this is for the year ended 30th. Hope it's clear now.
Yes, it is.
So that is our heading. Of course, you have to come up with a heading. So it's frame and French, statement of profit or loss for the year ended 30th September 2005. Okay, that's what we have. That's what we have. That's what we have as per our question. The amounts are in pounds, but I will use shillings here. Let us use shillings, because still your questions will be in shillings. So that's what we have. So you should be having those two different columns. In fact, we need 3, and the ones for the particulars. So do we all have that? Now we need to start entering the information. Okay. We need to start entering the information one by one. Now we prepare the statement of profit or loss for the year ended 30th September 2005. First of all, to find out how much profit these partners make. How much is their profit? Okay. So this statement is normally prepared to determine the financial performance of the partnership. Okay. We want to see how they are performing. Now, if you want to get the profit or loss, we normally we start with the sales. We start with our sales. Now, how much are the sales? How much are the sales? Let us go back to the question. This is the question. How much are the sales as per this information given? The sales are how much?
360.
The sales we have 363,111. Okay, those are the sales which we have. So we take them to our statement. So I'll write sales. I'll write sales. So we have the sales. The sales of how much? 36311. That is 111. So those are the sales. Those are the sales. Those are our sales. Normally, after getting sales, what do we do next? Members, after getting the sales, what do we do next? After getting the sales?
Sales returns.
We list returns, right? We list the sales. We list the sales returns. So do we have sales returns in the question? Let us try to check and see if we have sales returns. Do we have any sales returns in the question? No. So do we have sales returns, members? That's the
No.
question on the screen. We don't have sales returns. Please, you have to check where you have to go through the question and see if there's any sales returns. But in this case, we don't have any sales returns. So what you'll do, if returns are not there, then you go straight to the cost of what? The cost of sales. You'll say less the cost of sales. Less the cost of sales. Claire, what do we start with when it comes to the cost of sales? We start with what? When it comes to the cost of sales, what do we start with?
Me, I'm lost.
Lost.
I don't know. How did you get the 363,111?
The 3611, we pick that from the question. Okay. We pick that from the question. You see, I've shared the screen again. Sales. Have you seen that?
Yes, I have.
What you need to master is the format of coming up with the statement of profit and loss. So that's our sales figure. Members, we start with opening stock or opening inventory when it comes to the cost of sales computation. So we write opening stock. And how much is the opening stock? How much is our opening stock?
$62,740.
We have 62,740 as our closing stock. 62,740. 62,740. That is our closing stock. 62,740. That is our closing stock. That is our closing stock. Then now on the closing stock, what do we normally add? After the closing stock, we add what?
Purchases.
We add the purchases. So add the purchases. How much are the purchases? Why did you change the rates to UDX? Jen, I've used the shillings because that's what you'll use in the exam. Though the question I'm using, the amounts are denominated in pounds, but I've decided to use shillings, okay? Yeah, I've decided to use shillings because normally your questions will be, the amounts will be denominated in shillings. That's why I'm using shillings. Yeah, but in the question they are using pounds, but I've used shillings here in our solution, okay? Yeah. Purchases are how much? How much are the purchases? How much are the purchases?
210.
The purchases, we have 210, so you add them. Those who are still stuck on how to come up with the income statement, please master the format. We have to 10,000. Those are the purchases. Then after the purchases, what do we add next?
Carriage inwards.
We normally less carriage. We normally add inwards if they are there. You add the carriage inwards, then you less purchases returns. So do we have all those in the question? Peter, do you arrange inwards and purchases returns in the question?
I'm not seeing them.
They are not there. So if they are not there, then let's just see what to do next. We add these two. When you add these, of course, we call that figure the cost of goods that are available for what? That are available for sale.
Yeah.
Then we have to less the closing what?
Inventory.
The closing inventory. Now the closing inventory, you always find this in the additional information, please. You have to find the closing inventory. It will be given the additional information. So how much is our closing stock? As per the additional information, how much is the closing stock?
74.21.
74 to 10. Our closing stock is 74 to 10. Let's deduct that, 74 to 10. So you minus that, 74 to 10. It's a minus. It's a minus.
The gross profit.
Gross profit is not yet. We have not yet reached the gross profit. It's what we are going to do next. So after doing that, then you have to come up with your cost of sales. Your cost of sales is now how much? 198,530. That is this 272,740 minus the closing inventory. You get the cost of sales, which I've transferred to the second column. And I'm going to deduct this from what? I'm going to deduct this from my what? From my sales to come up with what we call the gross pro. To come up with the gross profit. So how much will be the gross profit now? Gross profit is sales minus the cost of sales figure. So our gross profit is 164,581. I don't know if you have that. Please confirm. You should be having a calculator there. Do we all have that? 164,581.
164,581.
Yes, 164,581. That's what we have as our That's what we have as our gross profit. What do we do after getting the gross profit? What do we normally add after getting the gross profit?
Discount received.
We add items like
Okay,
discount received, the other incomes, right? Let's try to check and see if there's a discount received in the question. You're likely to find that in the additional information. So discount received, do we have any, please? Do we have any discount received, members? Charlotte, do we have a discount received?
Discount received is not there.
We don't have a discount
Don't have
received.
discount.
Not there. We only have a discount allowed. Okay, then which other items do you add on the gross profit apart from the discount received?
My other miscellaneous incomes like commission received,
Okay.
interest received,
Interest.
rent income,
Insurance.
Insurance received, that is it's received. But then there is something we talked about
provision.
Sorry, you said what?
If the for example, have a decrease in provision.
If there is a decrease in provision, good. Now, to find out if there is a decrease or an increase, you have to go to the additional information and check and see. What do they say about the provisions for doubtful debts? What do they say about the provisions for doubtful debts?
They are saying we reduce provision for doubtful debts to 1,250.
Reduce provisions for doubtful debts to 1,250. But how much was the provision for doubtful debts before? We are going to reduce it. It was before, it was how much?
1,400.
1,400. So how much is the decrease?
1,500. 150.
How much is the decrease, members?
150.
150 is the decrease. Now that decrease in provision is added back. It becomes an income. Okay, it's added to the gross profit. So we say add decrease in provision for doubtful what? For doubtful debts. And to get this, we are getting how much? 1,400 minus how much, Peter?
250.
Minus 1,250. Give me the trial balance. So the decrease is how much? 150. So this gives us this now plus this income. We get 164,731. So you have to find out if the provision is reducing or if it is increasing. If it's increasing, that's an expense. If it's decreasing, that is an income. Okay? So what do we do next after adding these incomes? What's the next step now? What's the next step after
Less
adding
operating
the
expenses.
less the operating expenses? Hope the screen is clear. Is the screen clear?
Yes.
Okay, let us list the operating expenses. Less operating expenses. We are listing operating expenses. So I'll take you back to the question briefly. What are the expenses? Charlotte, Claire, Lynn, Scovia, What are the expenses now in this case?
You have office expenses,
That
salaries and wages.
Okay.
There is carried outward.
Carriage outwards, okay.
discount allowed.
Discount allowed is also there, okay. The bad debts are also there, don't forget them, okay. So far we have carriage outwards, discount allowed. Then you have the loan interest, PPRIS. This is the business expense. Office expenses are there. Salaries and wages are there. The bad debts are also there. All these are expenses. But remember, as I told you, that there may be some end of year adjustments. There may be some end of year there may be some end of year adjustments. We have some adjustments in additional information. What are the adjustments in this case?
Depreciation costs.
We have to depreciate the assets. We have to depreciate the assets, okay? That is 10% reducing balance basis. Then for the buildings, it's 5,000. Then what else do we have to do? We have seen the reduction of provision for doubtful debts. The partner's salary not yet entered. But then we have the expenses to be accrued. Have you seen them? The expenses to be accrued?
Yes.
That is office expense and what?
Wages.
The office expenses and wages have to be accrued. They have to be accrued. Okay, let us go back and we list these different expenses. So we have a discount allowance. How much is the discount allowed, members? I'd share the question in the WhatsApp group. I don't know if someone can be going there to check for us. 620, that's the discount allowed, okay? That is 620, discount allowed. Then what else do we have apart from the discount allowed?
Carriage outwards.
You have carriage outwards, good. Carriage outwards. That's how much, Peter?
2,410.
For 10. What else do we have? You have the bad debts. I saw bad debts somewhere. How much are the bad debts?
1,632. 1,632.
1,632. Then what else do we have?
Office expenses, they are there.
We have the office expenses. But when we look at the office expenses, do they have an additional information? How much do we have in the trial balance, first of all? How much do we have in the trial balance?
4,760.
4,760. But then we have an accrued, right?
Yes.
Accrued of how much?
105.
215. So that is 4,975, right? What else do we have apart from the office expenses?
Salaries and wages.
Salaries and wages. Under salaries and wages, what do we have?
Salaries and wages, we have 57,809.
57,809. But of course, there is an accrued, right?
Yes.
Of how much?
The accrued is 720.
720. There's an accrued of 720. Okay. So when we add 57,809, plus 720, you get that. Any other expense? We have the loan interest. The loan interest. How much is the loan interest?
Interesting.
Senior,
Yes, please.
why is loan interest an expense? Because I think I'm understanding it in a different way.
How are you understanding the loan interest?
I think I'm understanding it as interest got from loans that are given to those, maybe to those people of the business. Now I'm wondering, how is it an expense? According to my
You're
understanding,
looking
I
at
think
it. It's what?
according to my understanding, like the way I understand it, I see like it is an income.
Hey, you see it as an income. Yes, it is an income on the side of the bank. Okay? It's an income on the side of the what? On the side of the bank. But to the business which is paying the interest, it's an expense, madam. Okay?
Okay.
Yeah, you're right, but that is to the bank. Okay? But now the partnership got a business from one of the partners, and the partners is and the partner is charging them interest. That interest is an expense to the partnership business. How much is the interest, members? The interest is how much? Check in the trial balance. How much is our interest? Let me take you back. How much is the loan interest? We are back to the question. How much is the loan interest?
Interest is 3,900.
3,900. Okay, it's 3,900. Let's put that. Then after that, what next? We have to depreciate the assets, I think. What is the depreciation policy?
Depreciate fixtures at 15% of reducing balance basis. Buildings 3,000.
Fixtures, then the buildings. Now the buildings depreciation has been given. The depreciation of the buildings has been given as how much? 5,000, right?
On fixtures 15%.
For the buildings, and it has been given as 5,000. Then for the fixtures, what's the percentage?
15%.
They are saying 15%, but reducing what?
Balance.
What do we say about the reducing balance method? Who can
Cost
remind
minus
us? Reducing.
accumulation.
We get the cost minus accumulated pre-depreciation. How much is the cost of the fixtures?
8,200.
8,200, but of course their provision for depreciation that is given is 4,200. So it will be 8,200 minus 4,200, then times what we get. 8,200 minus 4,200. So how much will be the depreciation on the fixtures? Someone to work out that. How much is the depreciation on the fixtures? How much is our depreciation on the fixtures? How much? 6 what?
600.
The depreciation is 600, okay. Here we have 600. Any other expense now? I think those are the expenses which we have. Those are the expenses which we have. Claire and the Charlotte, are we together?
Okay.
Following.
Following. Yeah, you have to master the formats of the income statement, that is table of profit and loss, and then the balance sheet. So we normally get the sales, then we less the cost of sales. We get our gross profit, then we less the operating expenses. So what we are going to add all these expenses one by one. We are going to add them, then we deduct them from our income up there to come up with our net profit, if any. It can be a loss or a profit. So you get let's say I have there is something which I've not. Oh, okay. Yeah, that's what I get. That is 78,666. I don't know what members have that side. So do you confirm, please confirm the figure? Do we all have that? 78,666? Yes. Lynn, try to do the addition. Try to do the addition and we'll see. Is that the amount, please?
Yes, it is.
Okay, so we deduct that from our total up there. Then we get what we call the net profit. So how much is the net profit now? Me, I have 86,065. That's my net profit. I don't know what people have that side, but this is what I've managed to get. That is our net profit. That is our net. That's our net profit. That is our net profit. Anyone with a question, please, before we see the next section, because now we want to look at the appropriation section. Anyone with a question, please, before we move on to the next part?
I haven't understood where the net profit figure has come from.
Where we get the net profit from. Net profit, we are getting this figure, the total income. Let me call it total incomes. Total income, this. Do you see that figure? So we get this minus the expenses to come up with our net profit. Is it clear now?
Yes.
Okay, so that is our net profit. Now what we are going to do, we are going to look at what we call the appropriation We call it the appropriation what? The appropriation account or the appropriation section. Okay? The appropriation account or section. We call it the appropriation account or section. So what we are going to look at now. Comes after the income what? The income statement. Appropriation section. That is our appropriation section. So we have two columns, which I'll use for the shillings. I'll use this to record our amounts. Hope the screen is still clear. Yeah, so that's what we have. The appropriation section, okay, appropriation of profit section. Okay. Appropriation of profit section or account. Now here we start with our net profit. We start with the net profit. Where do we get the net profit from?
Profit and loss.
We get our net profit from the profit and loss. So my net profit is there. That is our net pro. That is our net profit. Then what do we do next? We have the format in our books. So you have to master the format. You have to learn it. What we do next is to add the interest on. We add the interest on the drawings. We add the interest on the drawings. Now, normally each partner will be charged the interest on drawings. So we have to find out how much do they charge as the interest on drawings. What are the charges when it comes to the interest on drawings? Yes, please.
I thought the net profit would be on the debit side. Why are we saying it either on the credit side?
No, these are just columns, okay? I'm just using columns. I'm not preparing a T account. I'm just presenting the information into different columns, okay?
So why are we having it on the last column?
Why are we having it on the last column? I'm going to use the first column for the additions. Then I'll be transferring the final figures in the last column, just like how you've seen in the other first part, the income statement. That way I have figures to add, subtract, I do them from the first column, then I transfer my final results in the second column. So even in this case, I'll use the first column for the additions, and then I transfer the finals to the last column. So there are two ways. Either you can prepare it as a T account, debit, credit, but now this is not a T account, okay? I'm just using two different columns in this case.
Okay, okay.
Yeah.
So you
interest
have,
on drawings, sorry?
so you have put it last being the where you're going to be summing from. Okay.
So interest on drawings, what do we have as our interest on drawings? Let us check the question and see the policy when it comes to interest on drawings. The drawings of the partners are there. Do you see the drawings? That is 31,800, then 28,200. But we have to find out what are the charges, what is the interest rate on the drawings. In fact, they have given us the interest on drawings. Normally, they will give you the rate in percentage, then you subject it to the drawings. But in this case, they are giving us the interest on drawings in amounts. Frame is 900, then French is how much? 600. Okay. So let us take them at our appropriation section. The interest on drawings, one is 900, the other one is 60, the other one is 600. So interest on drawings. There is a frame. Frame is how much? 900. Then I see there is also French. French is how much?
28,200.
600.
Right.
Not the drawings, but the interest.
Yeah, okay.
When you add these two, you get how much? Is that one 500? So you see now how I have used the columns. The first column I have used it for the additions. Then I transfer the final figure to my last column. Then after adding the interest on drawings, we also less. I can first here. So it is this plus this, giving us that. Then we are going to less the interest on what? The interest on capital. We less the interest on capital. So interest on capital, there will be frame as well as French. Frame and French. What are the interests on capital? What does Note G say about interest on capital? Who can read for us part G, Note G, additional information G?
Interest on capital account balances at 5%.
Interest on the capital account balances are 5%. The capital account balances are up there. Frame contributed how much as capital?
75.
Frame contributed
75?
100,000.
Huh?
One is 100,000, the other is 75, right?
Yes.
No.
So
One is 75, another one is 4,100. I hope I'm saying well.
there you're looking at there you're on the current account. Please check well, check well, check well.
The I is 100, then 75. Yeah.
Is it okay?
Yes.
But that we should get 5 per. We should get 5% as interest on capital. Okay. What is 5% of 100?
0.05.
5% of 100,000. 100,000. Don't forget to multiply by the amount.
Yeah.
That is how much?
3,000.
That is 5,000. Then 5% of 75.
It is 750.
Okay, let's take those amounts in our section. So for frame, it is 5 5% times 100,000. And that is, you said it's 5,000, right? Then 5% times 75,000. That's how much?
3,750.
3,750. You see, when I add these two, I transfer them to the last column. So it's this plus this, giving us that. Then I will also have to less partner's salary. Is there any partner who gets a salary? There is a partner who is getting a salary. Who is that partner? It's additional information.
Frame.
Frame.
Frame is
Frame
getting
gets
a
a
salary of
30,000.
that.
It's a salary of 30,000. So let us also take that. Partner's salary frame. That is 30,000. All these are to be deducted. So let us come up with now you get what we call the profits to be shared. So to get the profits to be shared, you will get this, then minus the interest on capital, minus the salary. Then you get 48,815. That's what you have. What? 815. Please confirm, and we see if that's the figure. I don't know what others have. We need to confirm this.
Yes.
That's it. So that is your appropriation of profits section. Now, these profits have to be shared. These profits have to be shared. How would we share these profits? We have to look at their profit, loss, and sharing ratios. So profit share. How do they share profits, members? How do they share profits?
Using their profit sharing ratios.
What are the ratios? Do you have those ratios? Sorry?
They don't have the one.
How we work the figure for profits to be shared? I'm kind of lost in that.
How would you get the figure for the profits to be shared?
That is helpful to them.
You see this? This, the net profit, we added the interest on drawings, we came up with this. Then you minus 8,750 and the 30. Remember, you're lessing the interest on capital as well as the partner's salary. Okay? Then you come up with this. You get it? Yeah. Members, what are the ratios? What are the ratios? Do you see them in the first statement, the first paragraph?
They are there.
That is what and what?
There's that ratio of a third and
That
a
is
half.
3 over 5. 3 over 5. And then 2 over 5.
5 and 2 and 5.
3 over 5 and then 2 over 5. 3 over 5. So this will be 3 over 5 times 48. 815.
Vale.
This is 3 over 5. Then times this. Then French. Now for French, it is 2 over what?
5.
2 over 5 times 48, 815. Aline, are we together? Aline, are you there?
Yes, we are together.
This is 2 over 5 times 48, 815. So we get that. And of course, this their profit shares should add up to the amount to the profits to be shared, which is still, that's how you share their profits. So the profit shares of each partner, as you can see. So that is your appropriation account. It shows how the profits are appropriated and then how they are going to be shared. Okay?
Senior, a question.
Yes, please.
In case we are not given the ratios, how are we supposed to share the profits? Are we supposed to share them 50-50 or?
That they say profits and losses are shared equally. Then you share 50-50, half. But normally, the ratios will be given, and if they're not giving you the ratios, then they will show you that they share profits and losses equally. In which case, you will use what? You will share them equally, half. But in this case, we have been given the sharing ratios, so it's what we have used to come up with the share of each partner.
Okay.
Normally, they will give you the ratios. Okay? So that is our appropriation of profit C section. Now, what we are going to do, we are going to come up with the partner's capital account and the current what? And the current account. We are going to come up with the partner's current account as well as the current what? As well as the current account. So let us prepare those two accounts.
Senior,
Yes, please.
the partners capital account and current account, do they go hand in hand with this profit account?
No, this is now something different. We first prepare the profit and loss account, the statement of profit and loss, then we prepare the appropriation account. Now that is one part. Normally, I can bring the appropriation account immediately after my net profit. I just continue, I say appropriation, then I just continue. Okay? But the partner's capital account and current account, these are separate accounts. They're not part of the statement of profit and loss. Okay? So you prepare them separately. They're not part of the profit and loss.
Because why I've asked,
Yes, please.
I am not seeing them in the question
Them on
being
the-
asked.
Oh, yeah, I know. They're not part of the question, but you always be required to prepare them. They will be prepared. Yeah. Sometimes they ask, that comes as part B. Now, but now in this case, they're not asking for these accounts, but you have to prepare them. Okay.
Okay.
Yeah. So partners capital account. So we have details. The partners, we have Frame and who? French. Remember, an account has a debit as well as a credit, side, French. I'm also going to explain the approach I've used because we have the fluctuating as well as the fixed capital plus current. So I'll explain after what I've used. So this is my account, members. The partner's capital account, it's just something, just a small account. In fact, I've used the fixed capital plus the current account. So I'll also prepare a current account after. Okay. So we are assuming that they are maintaining two different accounts. The capital and then the current ones, then the current accounts. Now in the capital account, you just enter the balances. You just enter the capital account balances of the partners, of the credit. So balance brought down. How much is the capital balance of Frame? Capital account balance of Frame is how much?
$105,000.
It's 100,000. Not so.
100,000. Yes.
Unless Frame introduced capital, but have not seen that anywhere. So the capital is 100,000 for Frame, then French 75. So in case of any additional capital, you can still bring that capital, but we don't have any additional capital. Then you balance your account with the balance carried down. So that is our balance. That is our capital account. That is our capital account. That's our capital account. So the assumption is that the partners are maintaining both accounts, the capital and the current what? So they prepare two different accounts. So this is the capital account. Now we are going to prepare the current account as well. Then I'll talk about the fluctuating. If it was fluctuating, what do you do with the fluctuating capital account?
So I have a question about the interest on capital.
Yes, please.
I thought we were going to add those interests to the initial capital.
No,
The capital.
that interest on capital, it comes as being that it's an appropriation of profits. Okay, it's shown in the current account. Yeah, interest on capital appears in the current account, not capital, not what, not in the partner's capital account. Okay. This is French. French. So this is your partner's current account. And I told you that this one records the shares of profits that the partners have earned from the trading activities of the business, appropriation of profits, all go through, we enter all that in the partner's capital, in the partner's current account. Now this account, of course, it starts with an opening balance, which you can get from the trial balance. Let me take you back briefly to the trial balance. You see, you have the current accounts. You have the current accounts of this partner. Yeah, you have a current account. Frame is how much?
4,100.
2,100. Then French is how much? 1,200. So still these are all. So they credited 100, 200. We credit their current account with the profit shares. Profit share. So check your appropriation section. We computed the profit shares already. So I need them here in this current account. They increase the current account. How much is the profit share of Frame?
29289.
For frame, we have
29289.
29289. Then French,
19526.
19526. 19526. Okay, then still this account is credited with the interest on capital. Interest on capital. How much is the interest on capital? Check their interest on capital. How much is the interest on capital for frame? Still check the appropriation account. We have all that there.
$5,000.
Then French,
3,750.
3750. We still credit this account with a salary. There is a partner who is getting a salary, and that was who? Who was that partner who is getting a salary? The appropriation account has
Frame.
that. Frame. A salary of how much?
30,000.
A salary of 30,000. So all those are credited. Then on the debit, you bring the drawings. The drawings. How much are the drawings for frame and French? You have to show their drawings. How much are the drawings for frame and French? Let's check in the trial balance. The drawings are how much? Should I take them back?
Frame is 31,800.
The drawings.
Yes. Drawings,
31.
frame is 31,800.
Then French,
28,200.
28,200. Then also debit the interest on drawings. And debit the interest on drawings. How much is the interest on drawings? You still have the interest on drawings in their appropriation account. You can check that out.
It's 900.
That is 900 frame. Then French,
600.
French is 600. So you see, we have entered the appropriations of profits. Those items that we use to appropriate profits. Those are the items we have entered in the current account. So now what we have to do is to balance it off. Okay? We have to balance off our current account. That is normal balancing of the account. So can we balance off that account? Of course, normally we have to find out which side is bigger. Of course, for frame, the credit side is bigger for frame, I think. It's bigger. The credit side is bigger for frame. Then for French, I think the debit side is bigger. So it's this plus this. which is 28 what? 28 800, I think. 28 800. Put this. I should also put this. So balance carried down. For frame, I'll simply get this minus this and minus this. That is the balance carried down for frame. Normal balancing of a T account. So you can balance as I'm also trying to balance up here. Is the balancing clear to everyone, or people still don't know how to balance accounts? Please, in case something is not clear, you can ask. Then we see how we can help you. Claire and the Charlotte, do we know how to balance accounts?
Yes, yes.
Now, when you try to look at this current account, you will see that one of the partners has a debit balance, that is French. One of the partners has a debit balance, and that is French. Then it's only a frame with a credit balance, meaning that frame has some money on his account, but French, his balance is negative. French has withdrawn more than what he had on the account. He has made more drawings than what he had on his current account. That's why you see that his balance is on the debit side, yet it's supposed to be on, the credit. So that is the partner's current account and then the partner's capital account. So here the approach or the method we have assumed is the fixed capital account plus the current account. The fixed capital account plus the current account. In other words, they are maintaining two different accounts, the capital account as well as the current account. Now, if they say fluctuating, it means that you're going to prepare a partner's capital account. In fact, you combine the current and the capital. You combine the current and what? You combine the current and capital. You combine the current and capital. So you prepare one account. So if they say they use the fluctuating capital method, then they prepare one account. So meaning that in this case, the capital account balances will keep on fluctuating, year after year. But in this case, we have assumed that they maintain two different accounts. So this is known as the fixed capital plus the current account method. So you have to prepare two different accounts. Any question before you go to the balance sheet?
Can you please come again about the fluctuating capital account?
Fluctuating the capital accounts. The capital account balance keeps on changing. It changes. Why? Because you're combining these two accounts. You prepare one account if it was the fluctuating capital account. You combine the details of the capital account and the details of the current account. So the capital account balance will not be the same year after year. It will keep on fluctuating. That's why it is called the fluctuating. So you combine the two accounts, capital and current accounts, if they say fluctuating capital method. Then the fixed capital plus current, you prepare two separate accounts, like in this case. Is that okay?
Yes, it is okay. Thanks a lot.
Let us do the balance sheet. Let us do the balance sheet.
Who is curious? Someone should mute.
Eileen, you mute yourself. Okay, so let us come up with a balance sheet. So that will be frame. You write the heading, frame and French. Statement of profit. Sorry, statement of acquisition. As at, they say the 31st when? 30th September 2005, I think. So that is my heading. As I told you, we need a column for cost. We need for accumulated depreciation. And then the net book what? The net book value, NBV. So use these three different columns in the balance sheet. Yeah, so that's our balance sheet. That's the layout of the balance sheet. That's the layout of our balance sheet. So what do we start with in this balance sheet, members? What we call the statement of financial position. So we start with what?
Current
We start with
The non-current assets.
the non-current assets. Good. We start with the non-current assets. So which assets do we have? Non-current. What do we have under the non-current assets? Non-current assets. What do we have? Which assets are non-current?
Have buildings.
We have the buildings. What is the cost of the buildings? What is the cost of the buildings? Members, how much is the cost of the buildings? What's the
200.
cost of the 200 what?
210,000.
210,000. Then what else do you have?
Fixtures.
We have the fixtures. What's the cost of the fixtures?
8,200.
How much?
8,200.
8,200. Okay. Now we can move to the depreciation. Some of you were wondering how I was getting the depreciation figures in the revision kit. When it comes to accumulated depreciation, we get the depreciation charges in the P&L, then we add the balances in our trial balance, then we get what we call the accumulated depreciation. So for the buildings, how much do you have in the trial balance? The depreciation of the buildings, how much do you have in the trial balance?
No, for the
160.
buildings.
Yes, in the trial balance.
It's 160.
For the buildings, you have 160,000. Sure. It can't be 160. Maybe you're looking at something else. Buildings, depreciation in the trial balance.
Now, about buildings, the difference is 50,000. Is 50,000 trial balance, and then
Let us check.
12,000.
Let us try to check and see. Buildings. Oh, their cost is 210, right?
Yes,
Their cost is 210, but they're giving us a value of 1 what?
160
So meaning that they are depreciated by how much?
by 50.
By 50. Then plus the
Yes.
charge for the current year, not so, which is how much?
5,000.
Which is 5,000. Good. Members, they are giving you the cost of the buildings to be 210. But they're showing you that their value as at the start of the year was 160,000. So meaning that before this current financial year, they are depreciated in value. Their depreciation was 50,000. There was a fall in value by 50, a fall in value of 50,000. That is at the start of the year. Then plus the depreciation charge of the current year, which is 5,000, making it to be 55,000. Net book value is costless accumulated depreciation. That is costless accumulated depreciation. Then for the fixtures, what do we have for the fixtures? Fixtures.
Fixtures work. There is one in the trial balance.
The trial balance is how
4,200.
much? 4,200
4,200.
plus plus the
Plus
charge to the
600.
P&L.
600.
That is how much? For 800.
Yes.
So giving you this minus this, giving us that. Total depreciation is how much? This plus this. This equals to this plus. So that is what we have. This is the total cost for the assets we have, but they have depreciated by these amounts, and these are the values, the valuations as at the reporting date. So the net assets are worth 158,400. Okay. Yeah. So from here, what do we do next now? What's the next part? After the non-current assets, you move to what?
The current assets.
We move to the current assets now. We move to the current assets. Under current assets, clear. Under current assets, what do we have? And by the way, what are current assets? What are current assets? Scovia, Charlotte, what are current assets?
These are assets which can be transformed into cash.
Assets which can be converted into cash within the
These are
period of one what?
that are used between the period.
Between what?
Okay, these are assets that are used within 1 year. Within 1 year.
That we use for a period of 1 year. Okay, there are resources, as you can call them, resources a company could use, turn into cash, or sell within a what? Within a year. Those are the current assets, okay? Those resources a company could use, turn into cash, or sell within what? Or sell within a year. Those are known as current assets. So, what are the current assets in this question? What are the current assets in the question? What are our current assets in the question?
What are the debtors?
We have the trade receivables. But let us start with inventory, because inventory is, we normally present this according to the order of liquidity. So we start with those assets that are not easily converted into cash, and one of them is inventory. Inventory is assumed to be a slow, inventory is slow moving, that it will not be easy for you to convert the inventory into cash. So we start with the inventory. That is the closing inventory of how much?
74 to 10.
That is 74 to 10. Then you can bring the debtors, as you called them in the question, debtors. How much are the debtors?
61,400.
61,400. But there is something we said about the debtors. There is something to do on these debtors in the balance sheet. What do we say about the debtors in the balance sheet and the provisions?
Of course, we subtract the provision for that full debts.
We have to list the provision for doubtful debts. The provision as at the end of the year. So let's provision doubtful debts. That is the provision as at the end of the year. How much is the current year provision? Check additional information. We reduced it to how much? 1 to 50, was it 1 to 50, 1 to 40?
1 to 50.
1 to 50. So we less, then we get our net receivables. At least we are sure that we are to receive this from our debtors. Then after the debtors, what else do we have? What else can we look at? What else?
Cash.
Cash or bank, or so do we have cash and bank, or we have cash and then bank as well? Let's check and see if we have our cash or bank, one of the two, or if they are combined, then you can still show them here together. So what do we have? What do we have in the question? Is it bank? Is it cash or cash and bank?
It's cash and bank. It's 130.
Cash at bank.
Okay, cash and bank, which is how much?
$630.
Which is 613. That is your cash at bank. Normally, there may be prepaid expenses, but we don't have prepaid expenses in this case. If you have prepaid expenses, we say those are current assets. We say those are current assets. Yeah, then we can add and get our total assets. Total assets, that is current assets total plus the current what? Plus non-current rather. You get your current plus the non-current, and we have that as our total assets figure. So that's total assets. That's what we have. Those are the total assets. Those are the total assets. From there, we move to equity and what? Equity and liabilities, right? So equity and liabilities. Equity and liabilities. And under equity and liabilities, what we have to do, we have to bring the capital accounts. Capital accounts for the partners. Remember, these partners have current account balances. We bring them and show them in the statement of financial position. So we have frame, and then what? We have frame and French. So check the capital account balance. The capital account you have just prepared. Frame is how much? 100. His capital account balance is still 100. Then the French, 70 what? French is 75,000. So this alone gives us how much? Gives us 175,000. Then you also bring the capital, the current accounts. The current account. How much is the current account balance of How much are the current account balances, members? Current account balances, how much do we have, please?
4,100 for frame, then 1,200 for French.
But one has a debit, right? One has a debit balance. Who has a debit balance?
French.
Okay, so we have Frame. Frame has a credit.
Sure.
We are going to check and confirm that one of them has a debit. Remember, debit is a negative. Vamubanja, right? Easy drawings were more than what he had on the account. So Frame has a credit balance, Frame. But then French has a credit balance of 4324. 4324 credits. It's negative, okay? So it reduces the current account. So it will be this, then minus that debit. You end up having 31,365. Those are the current accounts. Then from there, of course, we got the liabilities. From there, we move to the liabilities. Under liabilities, what do we have in the liabilities? Normally, you still have to classify the liabilities as non-current and current, but we don't know whether the loan from Prince is current or non-current. We don't know whether that loan is current or non-current, but we can treat it as a non-current liability. We are finishing. We have like around 20 minutes. We are finishing, please. We said we are ending at 8. Then tomorrow we shall continue and see if we can complete this topic. But still, I doubt there will be something left. Okay, non-current liabilities. Let us look at the non-current liabilities. Let us treat this loan from Prince as a non-current liability. Loan, Prince. How much is the loan? How much is that loan, members? The loan is how much? The loan is how much? 65,000. Okay, we have 65,000. Then move to the current liabilities. Current liabilities. Under current liabilities, what do we have? Under the current liabilities, what do we have? Current liabilities.
Of the creditors.
Mary, we have what?
Creditors.
We have the creditors.
We have creditors.
How
And
much
then
are
we
the
have
creditors?
accruals.
How much are the creditors?
26,590.
How much?
26,590.
26,590, those are the creditors. Then we have accruals. How much are the accruals? We can add them. What do we have for the accruals?
215 for office
15 plus what?
expense.
Okay, then what else do you
Plus
have?
120. We have 720 for wages.
Plus 17.
720.
Plus 2720.
7. No, it is 720.
Like the
Okay, okay.
720.
Okay, 720 plus
Oh.
215, right?
Mm.
Plus 720. So you get how much?
935.
935. Okay. This plus this gives you this. We are going to add and get our total equity and liabilities. So I have the capital account total, which is that. We add the current account as well. We add our non-current liability as well. Then you also add the current liabilities. You get to 98890. So this is total capital, okay, total equity. So this is total equity and liabilities. Total equity and liabilities. Total equity and what? And liabilities. So that is your statement of financial position.